Should I flip this house or should I actually keep this house as a rental property? This is the question a lot of investors ask me on social media. And today I'm gonna share with you my mindset and my strategy on when I keep a property and when I actually flip a property. To own rental property, it's all about mindset at the end of the day. You really have to see the bigger picture, the benefit of owning rental and what it takes to actually accumulate and have the delayed gratification mindset, so that as you buy property and you let it, appreciate and you keep raising the rent, eventually 10 years down the road, 15, 20 years down the road, you're gonna have 10 grand, 20 grand, 30 grand, 40 grand, 100 grand a month in passive income. When you have these kind of passive income and you can see the benefit, you can be on vacation, let's say Maui, where I love to go, and you can stay there as long as you want. You don't have to go back to work. I've been in a position where I go on vacation when I'm younger, and I get there and I'm enjoying myself, and then knowing that a week is up or 2 weeks is up, I gotta go back to work, it used to kill me. And I told myself, I'm gonna set myself up so when I get older, and if I don't wanna go back home after 1 week or 2 weeks, I'm gonna stay, because why? I got enough passive income so I don't have to go back. This take a mindset of delayed gratification. The people who flip houses, they have the mindset of instant gratification. All they want is find money, fix it, flip it, and make a big chunk of money so they can actually take the money and have a good life right now, which you should. Save some of that other money, park some of it on buying rentals, so you can have both. I have both. I have a good life all these years. I've been making good money, and I also have set up myself in the future, so I actually have even a better life in the future. So if you want to own rental property, folks, you got to really focus the mindset of delayed gratification so that you can set yourself up so one day when you're on vacation, you don't have to ever go back if you don't want to. And to me, you guys, this is freedom, option, and choice. I'm going to share with you guys now my point of view and my own experience on when do I actually keep a property and flip a property. There's two factors that I look at, okay? Now, there's a few other factors that are going to these two factors, but we're gonna talk about these two high level, and I'm gonna share with you the more detail of it. I will go through the number on some real property, okay? Factor number one is appreciation. I look at property and I wanna ask myself, do I wanna invest my money long-term in this location? And this location is gonna have good, solid appreciation, so later on that my property has grown and I have actually got a giant nest of net worth. I've been in a situation where I bought property where it didn't grow in appreciation, so after years of owning it, it didn't do as well as I like it to do. So that's why today, appreciation is very important to determine if I'm gonna keep a property or I'm gonna flip a property. Now, the second factor I wanna talk to you about is cash flow. Everybody always talk about on social media, right? It's all about cash flow, it's all about cash flow, it's all about cash flow. It is about cash flow, but it's more than just cash flow when you actually invest in real estate. And I'm gonna show you my point of view on cash flow property versus appreciation property, okay? And the balance of the two. So today, I wanna show you my take on these two factors. When I see these two factors and my mindset that go along with it, I'm gonna share with you when I keep a property or when I flip a property based on these two high-level factors. Sounds good? Let's go. Let me just go ahead and just set the tone again. Whenever you invest in real estate, there's four markets, okay? I talked about this in one of my other videos. There is an A market, B, C, D. A market is the high-end market, okay? These are areas where, very expensive area, very good school district, and these usually have lesser cash flow, but good in appreciation. They have high appreciation, okay? Now, D is the opposite of that, okay? And this is the area where very slow appreciation, and it gets, relatively good cash flow because prices are much lower there. A little more high crime. School district is not that great. Not a lot of box retail in those areas. C is coming out of the D, and then B is more stabilized, and then of course heading towards A. If you ever want to buy rental, you want to buy in the balance area. Balance meaning it's between the A's and the D's. You can fix and flip and wholesale in all A, B, C, D market. But if you ever want to own rental, you want to stay in the middle, which is the balance of both A's and D. Nobody talk about this. This is why when you do real estate, you got to understand not every market is made for rental. That's why there's not a lot of people talk about rental. They always talk about fix and flip and wholesale. I'm giving you the secret. You can fix and flip in all market. If you want to actually own rental, you want to be in the B's and the C. Get it? I had the opportunity to buy this fixer-upper. It was a fixer, okay? And it was $600,000 purchase price. It cost me 150 grand to rehab this property. So I'm all in for $750,000, okay? All in. This property was worth $1 million ARV. That means there's $250,000 roughly before commission closing costs of sweat equity. This is what I call a 25% deal. In the world Burr, this is a good property to keep because it has 25% margin. That means if the bank came out and they gonna refinance this from hard money, give you a loan, they'll give you 25 to 30% LTV of this $1 million. Right now, they're not giving a lot of 30%, but let's say they give you 25%. 25% of basically $1 million, they will give you a loan up to $750,000. So if you all in for $750,000, you can actually finance 100% of this, okay? So this right here, if you look at this right here, man, this is a Burr Thach, but that's only one component of keeping it. The other is with a cash flow. So let's say, right, I was gonna finance $750,000. $750,000, all right, loan amount. If I was to do that right now at 7.5% interest rate, the principal and interest just by itself, it's about, I ran the number, it was about, I think it was like $5,400 a month. Just on principal and interest, okay? If you add property tax and insurance, even property manager, you're gonna be easily over $6,000 a month. Over $6,000. Now, this property here, the max I can get for rent was $5,000. So it had 25% sweat equity. That's a Burr. But at $750,000 loan amount, I'd be negative, easy over $1,000. So in cash flow, it didn't make any sense. Now, the only time this will make sense, okay, if you have a lot of money sitting around and you need to actually just park some money to get the tax write-off. There's people I know that have a lot of money, okay? They say, you know what, I like this location. It's an A neighborhood, it has good appreciation, I like it. And, you know, since it's financing 100% original down payment, when you buy these deals, the original down payment of 20% will go back in your pocket. In order to make this deal at least break even, you gotta get this loan amount down to $650,000. At 7.5%, this would be like basically $4,400, $4,500 in principal and interest, okay? And then you add property tax and insurance, you'd be at $5,000. You'll break even. So in order to make this deal work, you gotta put in an extra $100,000 to get this loan amount down to $650 to break even. Who does that? People with money. Because in these high-end neighborhoods, they're people with money. So they don't mind buying homes, right? That the ROI doesn't make any sense, but they don't buy it for the ROI. They buy it for the appreciation. Now for me, I don't take on investor. I do everything with my own money. So I don't want to leave an extra 100 grand, right, in this house, so I actually keep it. I'd rather go and buy property in the B's and the C's so I don't have to put up that much money so I can own a lot of real estate. And if I can get a balance of appreciating cash flow, I'd rather have a bunch of those than a bunch of high-end property where I gotta feed a lot of money into it just to break even. That's why the A market, it's great for appreciation, but it doesn't do well in cash flow. And that's why someone who actually keep these properties, they have to dump a lot of money in it. This is why on this deal right here, I actually end up flipping it versus actually keeping it. Make sense? All right, now I'm gonna talk to you guys about the opposite end, right? Which is more like the D market, okay? I was presented many deals out in area like the Midwest. In the Midwest, you can buy basically a house turnkey for about $100,000. Turnkey, ready to go, okay? And if you actually, right, buy this property, if you already own a few property, you gotta put down 20%. That means that's $20,000. You have a loan amount, right? You have a loan amount for 80 grand. And I ran the number. If you have a loan amount of 80 grand, a 7.5% interest rate, your monthly payment is somewhere around 500. I think it's $550 a month, principal and interest, okay? If you add up property tax and insurance and everything, right, you might be up there probably, I would say maybe even 700 to maybe 750 a month, okay? On a house like this, you can actually get about $1,000 a month, or maybe even $1,200 in rent. So at $1,000, you might make, call it $300 to maybe $500 a month in rent, with basically 20%, with 20% down, which is 20 grand. This cash flow well, okay? However, when I look at the area, the location, when I look at, right, the appreciation, the standard on the type of tenant that comes along with it, I don't want to actually invest in this area because it doesn't meet my standard. For a lot of you guys that don't know, when I started real estate 30 plus years ago, the bulk of my rental property back then was a lot of Section 8 housing in Seattle. And matter of fact, still today, I still have a bulk of property today where I actually rented Section 8 to nonprofit in Seattle. Then what happened was I moved a bunch of my property into more like B's and C area the last 20 years. Because what I experienced, so I'm showing you my own experience, that these location, the D area in Seattle, even certain area in the Midwest, that these area and the appreciation, it didn't do well. I bought a property for, I remember in that area for like, I want to say it was like 139,000. And then like basically, 25 years later, the property owner went up to like $180,000. It didn't even double. And in Seattle, you would think it doubled, right? But not in certain area. It didn't do well. So I had a bunch of these property. And eventually what happened was I sold them and I 1031 them into B's and C area. They're more expensive, but as my property grew a little bit in equity, I just 1031 took all the equity and just bought homes in the B's and the C area. So it gave me a better appreciation. Today, all the property I buy in B's and C, they have an average of 7% appreciation. Even better, some of them are in the 5%. That means that roughly every 7 to 10 years in Seattle, I've noted based on history owning my property, it has doubled in value every 7 to 10 years. And that's why I love it, because my net worth grows rapidly. And so I chose today not to invest in the D area because I want better appreciation. I want to have property so that 20 years from now, right, I have 100, 200, 300, $1 billion in net worth. And some of these areas in the D location is not going to help me with that. And then basically the tenant. I don't want my whole entire portfolio in Section 8 because every time the tenant moves out of the housing that I rent to a nonprofit, I got to spend a lot of money basically putting it back, making it look nice. And then I rent it back out to them, and then eventually they live there for a while. When they leave, then I got to spend a lot of money to put it back together again. These homes, when I remodel them, they look nice. When they leave 10 years later, house look literally still nice. I just got to paint it. So I just basically choose me not to just do all Section 8 anymore. I got a percentage of it, I'm good with it, but I want to move all my property into B and C because I want better location, I want appreciation, and I want a standard in tenant where when something happened during the economy or people laying off, the B's and the C, they still do well in their job. These area down here, they usually get laid off quick. Now, some people say Section 8, they guarantee money. That's the benefit of Section 8. But I just choose not to put all my rental in Section 8 anymore. I want to basically have a small percentage and a bulk of them in the B's and the C. This deal right here, you guys, I don't do anymore. And when people send me these deals in the Midwest, I'm not interested. Even though cash flow better, I want the balance of B's and C, not just in the D only. Make sense? All right, so now I'm gonna give you an example of a deal in between A's and D. I call this the B's and the C location. Today, what I do today is I go and I actually look for property in the B's and the C, let's say in Seattle, okay? Now, what I like to do is I always like to buy property, okay, in the B's and C, in the C's, and it works its way into the B, because I know I get a better deal here and it's moving towards B, okay? Now, I won't get too complicated with this, but I'm gonna show you something. I like buying single family fixer with the potential of putting a detached ADU in the backyard, okay? Now, I won't go through the whole number on the fixer-up houses, but I'm gonna show you the number on the Dadu. Hear me when I tell you this, folks. All across America, ADU is the new cash flow game that's gonna happen in the near future. Every city across the United States, especially expensive city, especially high density area, all the way to Hawaii, more and more city council are allowing people to put second dwelling units on their single family property so they can actually create more rental housing and more houses for people to actually buy. In Seattle, we can buy a house and we can actually, what I call condo, they call them condomizing, and they can separate these and they have two separate tax ID numbers. You can sell them separately. California, they just had this approved. More of this is gonna happen across America. So a lot of you guys right now, you can put ADU in your backyard, you just can't get the two tax ID number yet. But that's coming, don't worry, it's gonna happen. So in Seattle, I'll give you an example why I love doing ADU Seattle. I can build 1,000 square foot detached ADU in the backyard. It cost me all in about $350,000. Construction costs, soft costs, everything, all in, $350,000, okay? These properties, since it has its own separate tax ID number, they comp them like a regular house. On a brand new 1,000 square foot ADU, today they're worth $700,000. ARV. Some area is worth 800, 900,000 in Seattle. Okay, that's moving toward the A neighborhood. Okay, the problem with that is you can't get enough rent for it because it's gonna cost you a lot more money to build those area. But I like doing it in the B's and the C. $350,000 the cost to build it is worth $700,000. Okay, if I went to the bank and the property is appraised for $700,000, the bank will give me 75% LTV, $700,000, and the bank will give me 75% LTV. They will loan me up to $525,000. That's how much they can loan me up to, $525,000. But I only need $350,000. So I won't cash out. That's one of my theory. I will not cash out all $525,000. I will just tell the bank, just give me a loan for $350,000. Just give me a loan for that. So I'll finance 100% of this whole cost. Now, if I take a look at $350,000 right now, and I put a 7.5% interest rate on this thing right now, the principal interest is about $2,400 a month. Property tax and insurance, you know what I mean? It could be up to like $2,700 or maybe $2,800, okay? Call it $2,800. I can rent this house out in Seattle for $3,500. That's $700 in positive cash flow, okay, a month. In certain areas, I can get $4,000. At $4,000, right, I'm making $1,200. But at $3,500, I'm making $700, you guys. And I get 100% financing. I have no money vested in this deal. I have a property with no money vested. I have $350,000 with the equity, 750 is worth, loan amount of 350. That's 350,000 with the sweat equity, no money vested, and I get $700 a month in positive cash flow. This area B and C, this property will double 7 to 10 years. Let's say 10 years. In 10 years, this property will go from 700,000, 1.4 million. So my appreciation is going crazy. And this area has good tenant and they have good high rent. So I can have no money vested and I can still cash flow $700 with no money. And I'm in a B and C neighborhood. This is a no-brainer. This is why I spend so much time buying fixer house with ADU potential in Seattle, because I make way more money doing this with no money out of my pocket at the end of the day, and it has good appreciation and good cash flow. This is why this is the balance of the A's and the D for me. This is why I do so much of this. This, you guys, is the new game changer. ADU is the new game changer all across America. Hawaii is having it, everybody's having it. But the key here in Seattle, we get to have separate tax ID number. And you guys who don't have it now, it's coming, okay? It's coming. This, you guys, is a keeper all day, all night. Bam! That's a wrap, you guys. Now you see now, for all you guys have been asking all these questions, when do I actually keep a property? When do I actually flip a property? Hopefully today you see, in order to keep a property, you gotta have the mindset of long-term and delayed gratification, okay? Then you gotta understand cash flow and appreciation. You gotta understand A, B, C, D market. And you gotta know what is the type of property that's gonna give you the balance of both in your area. If you don't know, look, I'm happy to help you guys. You gotta know I own a company called Springboard to Wealth. We teach people how to do this kind of stuff and own rental property all across America. So if you wanna know more about Springboard, the link is below, okay? So y'all like this video, give me a thumbs up. If you have any question, any comment, please put it in a comment, all right? And if you haven't subscribed to the channel, please do me a favor, hit that subscribe button for us. For all you guys who already subscribed, thank you very much. We wanna hit 1 million subscribers here by the end of the year or sooner, right? Until then, see y'all soon. Peace.